Hi everyone, I'm Adam Thurgood of Hightower, Las Vegas. I'm joined by Raina Penalova, our Director of Research. Welcome to another edition of our interview-style client briefing series. This one's going to be a little less interviewee, more conversational. We both have plenty we'd like to say, so rather than one person ask the other some questions, we'll just talk about markets basically and what's going on in the world. It's probably best to start off with what's happened so far this year. It's been a very interesting year.
Like always.
Yeah, I think the big surprise for most people this year, and maybe not necessarily us, is just how well gold has performed. It's been the best performing major asset class this year, up 15%. The S&P 500 is up about 11%. Again, that's dominated by the big tech names. If you look at the Dow Jones Industrial Average or say international stocks, they're trailing at around 5 to 6%. Eventually that trend will shift. It always does. But for the past 18 months or so, the tech names have certainly helped the S&P. But the big loser so far is, again, bonds. Bonds are down 1% this year. That's an aggregate index, so of course it includes the impact of longer-term bonds. Shorter-term bonds have done much better. But it's another set of returns that's very interesting and perhaps a big surprise for a lot of people.
Mm-hmm. And this whole cycle has been very different from what we are used to in the last 30 years, right? And it's really because of inflation, and it's because this is why the market is hyper-focused on inflation right now also.
Yeah, and we just got the latest inflation data, and it showed core CPI at 3.6%. We tend to like to look at more short-term measures to get a sense of where inflation is headed. And if you look at core CPI on a 3-month annualized basis, it's running still over 4%. And the super core measure, which is what the Fed likes to focus on, which is core CPI less the impacts of shelter, is still above 6%. Neither of those levels are anywhere close to the Fed's 2% target, but yet they're talking about cutting rates. It's a very strange environment.
And those are the measures that the Fed is looking at that remove the volatile energy and food components, which is interesting that even they are running at these high levels right now. But also, if you would like to get an indication of where inflation is headed in the future, it's best to just look at oil prices and how they have been trending in recent months, because energy really has an effect on all these core components as well.
Well, it's because energy goes into the lights in the building, it goes into the gas and the diesel that transports things across the United States and across the globe in shipping containers. So energy has such a massive impact on everything we do. And when we look at not necessarily a short-term basis, but a long-term projection, structural projection, we think that energy prices are likely to be higher over time because there's been a structural investment in the infrastructure.
And demand for energy has really increased in recent years as well. So the estimates for how demand is going to evolve in the future is also always continuously revised higher and higher.
Yeah, and if you think about economic growth as energy transformed, that makes a lot of sense in that context. And one of the big reasons why global energy demand is up is that emerging markets are emerging. Places like India are having a lot more wealthy people. Well, wealthy is maybe not the right word, but people that are above a certain income and wealth threshold that can now afford a car or other goods. Maybe they want to travel a little bit, and that all adds to incremental energy demand.
Yeah, and also plays into what the Fed is going to do now. They're walking a tightrope. They have a dual mandate to keep prices stable and also to keep labor markets stable.
Well, high employment is the technical term, yeah.
Yeah, so it's very tricky. They've indicated they want to start cutting rates, perhaps because the government has to pay its bills also, but also because we're seeing some weakness in labor markets and in the economy as well, even though we've been seeing those cracks for a little while now.
But the cracks are not necessarily in the actual coincident data. They're more in the leading indicators. Mm-hmm. One of the measures that we like to look at is the Small Business Optimism Index and how hard jobs are to fill. And when that's going down, it means that businesses are having an easier time filling jobs, which probably means that there are a lot more people looking for work. And it's been a pretty good recession indicator when the short-term average is crossed below more of a longer-term average. And we've been in that state for a while now. And there are other leading indicators that we look at as well, and they're all kind of pointing in the same direction, yet the unemployment rate is still below 4% and has barely moved up. I mean, it's up, what, about 0.5% from the lows? Now, that being said, if you look at a very long-term graph of the unemployment rate, it tends to look like a momentum indicator. Well, once the unemployment rate goes above the 2-year moving average, it tends to take off in one direction or the other. Well, if it's going above the moving average, it tends to continue up and vice versa. And we're now in that state just because unemployment was so low for so long.
And the Fed probably is aware of that.
Yeah, that could be why they have a bias to cut rates. But if you think about it from the perspective of their dual mandate, cutting rates with inflation elevated is a no-no, and cutting rates when you have full employment is a no-no. So they must think that the policy is extremely tight and that the pain from higher interest rates is just around the corner if they're thinking about cutting rates when inflation is too high.
Perhaps, and a lot of people are really thinking about mortgage rates and are just saying, why don't they just cut interest rates now? Mortgage rates need to come down. People can't afford to buy houses. But this is not exactly how it works necessarily, because mortgage rates don't really depend on the interest rates that the Fed control on the short end of the curve. They depend on the interest rates on the long end of the curve.
Yeah.
And how you construct that interest rate is you factor in first growth expectations for the duration of the bond, inflation expectations, and then you tack on an uncertainty premium called the term premium. So if the Fed was to cut interest rates right here, right now, when the growth is still considered resilient, when inflation is running at higher levels than where it should be, then you can expect for those expectations to increase, for expectations for both inflation and growth to increase. And who knows what happens to the uncertainty premium, but it could also go up in that scenario. So it would be very ironic if you see the Fed cut interest rates right now, only for mortgage rates to increase.
Yeah, and on that point, you've heard a lot of chatter about, well, the Fed's going to cut rates to help Biden get reelected. Now, the Fed is supposed to be completely apolitical. Now, they certainly, I'm sure that there is some political bias inside each Fed administration. But if they were to cut rates and inflation were to ramp up into the election, that would be pretty bad for Biden.
Yeah, can you imagine right before the elections too? So if it's a very tricky situation that the Fed is in. If unemployment really starts increasing more substantially, they could lose that momentum and it could really accelerate from there. Yeah. It could become much harder for them to come back from, for growth to come back from that. And if they cut interest rates too soon or become too supportive of the economy too soon, then they might have a battle.
Off to the races again.
Yeah. So
well, let's talk about...
I don't want to be in the Fed right now.
It would be a tough job to be Jay Powell for sure. Let's talk a little bit about politics. Let's dance on that fire for a little bit here. When we look at the betting markets, Biden had a pretty good lead, but it's come down quite a bit, and now Trump is actually slightly ahead in the betting markets. Biden's approval rating is still around 40%, which is historically quite low. Presidents don't typically get reelected when the approval rating is that low. But what's odd to me is that Trump is polling way ahead in almost every single swing state. The only swing state that Biden was polling ahead of Trump in was Michigan. Now, clearly, if Trump were to win all those swing states, he would have a landslide victory in the election. So we'll have to see how that plays out. Plenty of time between now and the election for, one candidate to strengthen their cause and their case. But it's, from our perspective, really important to understand the potential policy decisions and also the power structure that will be likely in place if a certain candidate wins.
What happens after the elections too.
Yeah, exactly. We care more about what happens after the election. How do we position? And there's, I can't remember which research provider said it. I think it might have been Strategas that basically said that elections don't tend to matter for the markets, but they matter a great deal for the sectors because certain sectors perform well under different administrations. Now, when you have bigger macro potential macro things in play like tax policy, that could certainly sway markets. But let's talk about the power structure for a second here, because historically speaking, whichever party wins the president, they tend to gain seats in the House. And right now the House is just mildly in Republicans' favor. So if Trump wins, you would expect the House to become even more Republican. If Biden wins, maybe there are enough seats gained in the House that it becomes Democratic. Now, the Senate is where the real interesting caveat to this power structure comes in. The Senate is basically 50-50 once you remove Manchin, who's retiring. And I think there are 7 or 8 contested seats this year, meaning it's not in a state like Utah, which is always going to have a Republican, or a state, like New York, that's probably going to have a Democratic senator. And all of those contested seats are held by Democrats. So if the Republicans pick up just 1 or 2, then likely the Senate is going to be in Republican hands. So if you think about what that means, if Biden wins, likely going to have a hard time having full control. But if Trump wins, it's highly probable that he'll have both the Senate and the House in Republicans' hands as well, which has a big impact on policy, or the ability to get policy.
And we have
through.
quite a bit of policy to be discussed next year too. We have the Trump cuts expiring, which is about $3 trillion. According to Strategas, I believe, had this calculation that about $3 trillion of tax cuts are expiring next year, so quite the fiscal cliff. We also have to increase the debt ceiling again, always a pleasant conversation there. And that is definitely going to cause some havoc in Congress. We also have to think about the implications when it comes to geopolitics, of course. No matter who wins, I think Biden or Trump, they're likely to be tough on China, but Trump is going to be more aggressive in that direction. I think the big difference is with immigration. Biden is likely to continue to be lax with immigration, but Trump is expected to have much stronger control on the southern border as soon as he gets elected. So that makes a big difference in this area. Also, when it comes to our allies like Japan and Europe, some people are saying that they expect for Trump to put some pressure on Japan and Europe to strengthen their currencies, because both of these currencies have been trending down, and it's well known that Trump would like to see American exporters be more competitive.
Which means a weaker dollar.
Which means a weaker dollar. So
you could certainly see him go over to Japan and say, look, here's your choice, tariffs or strengthen your currency. Japan's currency has been abysmal. It's fallen an unbelievable amount for a country of its size and standing in the world. And it's largely because it's one of the few countries left in the world that's still running negative real interest rates.
Yeah. And there's a lot of moving parts as to why the conditions are the way they are in Japan, but also money managers around the world are really paying attention to that, because Japan is the largest foreign investor, and due to those negative interest rates. So if that was to start to change, we could expect for capital flows to really change directions in the future. And it's something important to keep an eye on.
Yeah, for sure. So when we talk about portfolio positioning, one of the things that we've heard a lot of inquiry about is artificial intelligence. Mm-hmm. So what are your big thoughts on AI?
AI, I think we can both agree that it's likely to prove to be transformative technology. There's a lot of unlikely beneficiaries right now in the economy, a lot of investment in that area. But we know from 1999 and 2000 that when the internet boom happened, that even the biggest beneficiaries from the internet boom benefited a lot in the beginning, but that didn't mean that their stock prices went up and to the right the entire time. In fact, they suffered some really major declines in 2000. So we have to be very careful how we are exposed to the theme. And that's why we've added some specialized research in technology specifically to better understand how things are evolving and how to benefit from the new trends.
Yeah, there's a saying in technology that people tend to overestimate the impact in the short term and underestimate the impact in the long term. And that seems to be playing out with a lot of the AI hardware names today. But I also find it really interesting how AI could benefit things like biotechnology companies, where they can use AI to build better drugs. Maybe that brings costs way down.
Yeah.
In the pharmaceutical space.
And also much faster.
We've also seen it impact utilities because the power demands are so high.
Yeah.
That's helping the nuclear theme, for example, because we've seen a real shift globally towards nuclear. And now these AI chips demand so much power that we need even more power sources. And nuclear is probably going to be a big part of that.
And speaking of energy demand, these new AI data centers require a lot more energy. So that causes the estimates for future energy demand to increase once again.
Yeah, and we've talked about, I think, plenty of times our bullish stance on energy in general. This just adds to it. If you look at energy in terms of power production, natural gas and uranium, we're bullish on both of those commodities, but also just flat out oil is becoming more in demand. The emerging markets of the world are emerging, and that means more and more of the average citizens there can afford vehicles, they can afford to travel. So the world is going to need more energy sources, and we've had a big underinvestment in that category for a long time. So we remain overweight in energy.
Yeah. We should also mention that if you are interested in AI, disruptive innovation, for example, the aggressive portfolio has a dedicated sleeve, 15% dedicated to disruptive innovation. We have more asymmetric bets in that portfolio. I mean, the name says it all. It's more aggressive.
The aggressor is meant to be aggressive. It's by far our most aggressive portfolio. And it doesn't have as much macro risk management. It's meant to really give you exposure if you want high beta exposure to the markets. Now, in our optimized portfolios, which most people have because those align pretty well with financial planning objectives, we remain overweight in gold. We put out a video not too long ago about gold and the reasons that we're bullish. But I think it'd be useful to talk about what might change our mind there.
Yes, I think we've been bullish on gold for quite a while, and think people are going to conclude that we're just always bullish on gold, perma-bulls on gold. But that's not exactly the case. The reason for why we're bullish are more structural. So I think that, let's say, central banks are really serious about bringing inflation down. Governments become more fiscally responsible. They stop spending as much as they have been in the past. Get deficits back in control, and that's not going to be very bullish for gold.
No, and gold and bonds tend to be great hedges for equities at different points in time. And really since the financial crisis, really since the turn of the century, gold has provided a much better hedge against equities than bonds. There have been obviously certain spells where one or the other has performed better. But if we got back to much higher real interest rates, where let's say the 10-year Treasury yield was above nominal GDP growth, then that would be a situation where you'd probably want to own more bonds than you would gold in terms of hedging the portfolio.
Yeah, I mean, clearly one of the reasons why gold has been doing well is because central banks have been buying gold. They've been diversifying their foreign reserves away from bonds into gold. And if bonds were to become very attractive for central banks, that could stop or perhaps even reverse.
It's just hard to see interest rates going that high given how much debt is on central bank balance sheets.
I mean, clearly they're pulling all the stops right now to control interest rates on the long end, and with the Treasury and the Fed always doing something to alleviate pressure from the long end, it tells you that they're worried about it and they don't want interest rates to get too high.
Yeah, and just the fact that people now talk about fiscal dominance, where the Treasury basically overwhelms the Fed's ability to handle the inflation and growth outlook. The fact that fiscal dominance has become a term that a lot of people know now tells you that this is a serious issue that will have to be resolved over time. Also, the fact that every time the Treasury announces its quarterly refunding structure and how many bills they're going to buy versus how many bonds they're going to, or sorry, how many bills they're going to issue versus how many bonds they will issue. The market's hyper-focused on that. That's never happened in our career. So it's telling you the market is starting to worry about the debt situation. So in terms of the fixed income allocation, the bond exposure in our portfolios, we do have a lower duration and are very concerned about that. And we also have a fairly healthy exposure to what are called TIPS, Treasury Inflation Protected Bonds, that give you an interest rate plus inflation to help manage some of that risk.
Which means that we have lower sensitivity to interest rate risk, to interest rates going higher, but also going lower. And a component of that has some inflation protection embedded in it.
Yeah. And then in our Defender portfolio, that is probably the most diversified of all of our portfolios. Can take pretty sizable positions in things like commodities and precious metals. That portfolio's got over 20% in gold and 15% in commodities. It's done quite well this year. We don't see significant changes there, but a lot of it is model driven. So for now, it's doing well and it's highly diversified.
It's rules-based, based on many different indicators, some of them economic indicators and their correlations, some of them market indicators, what has been doing better as a hedge, bonds or gold. Yeah. So when bonds really become attractive and start to perform, that portfolio is going to switch away from gold as well. Yeah. But for the time being, it remains fully invested in it.
And I think if we summarized our overarching view of how to position right now, it's to be a bit careful. And the reason is that you can be paid to be careful. You're getting 5% in short-term treasuries, and if you own the more value-oriented parts of the market, you are getting potentially much better expected forward returns. So we're really positioned for a structural rebound in global growth, but at the same time being conservative in our cash allocation so that if things roll over, we can take advantage of it and have that dry powder.
Yeah, and I think it's important. It makes sense to search for quality and to have more resilience built in a time when we have heightened uncertainty. Yeah. When we look into the next year after the elections.
Yeah. So we'll see how it goes. Well, that's all we have for you today. Make sure to check out our website. If you have any further questions, you know how to reach us, and we'll go from there.